Our next speaker, again with a focus on North Asia, is Charlie McElhone, the Group Manager of Trade and Industry Strategy at Dairy Australia. And I'm sure Charlie is well known to many. He's been involved in a range of different agri-political organisations, including the National Farmers Federation, as a General Manager Policy. So please welcome Charlie McElhone.
Thanks, Mick, and good morning, everyone. It's good to be here, talking from a dairy perspective about the North Asian markets, and particularly in terms of what kind of impact we can expect from the recent FTAs. As has been discussed earlier today, it has been an unprecedented year in trade policy, particularly looking at that North Asian region. Doing three FTAs with such enormous markets for us, contributing about 40% of our total export revenue, has been enormous. But in reality, it's been a mixed bag when it comes to the dairy industry when we look at those three trade agreements. Starting with Korea, as a standalone agreement, Korea wasn't a bad agreement. There were a few areas that were left off the table: milk, condensed milk, and powders. But the reality is that we do travel behind the United States and the European Union with our trade agreement. We'll talk a bit about that later. Flipping across to Japan, and Japan was a real disappointment for the Australian dairy industry when it comes to that FTA that we finalised with Japan. Not a liberalising agreement, and only marginal market access opportunities emerging from that. But then that takes us to China and what we would affectionately know or refer to as the dairy deal. And obviously we're very happy as an industry when that China free trade agreement was undertaken. But you can see there from those three agreements, it's a very different, very mixed bag in terms of opportunities and how we see those three agreements as an industry and the opportunities that emerge from those. And that's the reality of trade agreements in this day and age, where in getting them finalised, and there are trade-offs that occur through that process. But flipping back to the Australian dairy industry and where does our trade go, and you can see the importance of that North Asian market. As of last year, for the first time, Greater China overtook Japan as Australia's leading largest dairy export market, with about 19% of our total trade going to that market. We still retain and still maintain a market-leading position in Japan, and Korea is about our 10th largest market. But you can see that real hubbing towards that Asian region and the Middle East, of course. Flip back sort of 30, 40 years ago, and obviously that was much more focused on the United States and European Union. But our focus as an industry is now very much on that Asian region. So who's importing all the dairy? This is total dairy imports, and it's very hard to look at this chart and not be taken aback slightly by that Greater China dairy import story. And obviously this goes back to just after that melamine incident, and just looking at 2013 alone, with a 40% increase in dairy imports into that market, importing over 2 million tonnes now, and it's quite an enormous story. But it's easy to look at this chart and overlook some of the significant growth that we're seeing in some of these other regions as well. Southeast Asia has had solid double-digit growth year on, year out, despite what we've seen some quite high prices in recent years. Similar in the Middle East. Japan and Korea is a different story, obviously, for us. And when we talk about those markets, we're talking about mature markets. Growth in per capita consumption of dairy has not been at the same kind of level that we're seeing in those developing worlds. But still, solid importers of dairy production. But why the excitement about the China Free Trade Agreement? Obviously, it goes down to some of the figures which are quite mind-boggling when you talk about China. We all know about the 1.3 billion people population, which is obviously about 75 to 80% self-sufficiency, importing about 10 to 15 billion litres of dairy product each year. We only produce, as a country, about just over between 9 and 9.5 billion litres. So you can get a bit of a feel of the context. When you talk about the population, you're talking about 16 million babies born every year. And with a recent relaxation of the one-child policy, expected to be another, estimated between 2 and 4 million babies. So when you're talking about dairy, obviously you think about infant formula, and so it's no surprise that with that we're seeing a huge amount of investment going into that infant formula area in the Australian industry. And obviously, as I mentioned before, the lack of trust in the Chinese domestic product with their food safety record post the melamine incident, and there are still ongoing issues in that space. Looking at per capita consumption though, while we do recognise that there has been some concern in the last 6 months or so with dairy prices in China coming off, a reflection of their market economy status, and with the global markets falling away somewhat, per capita consumption remains very low in China relative to, particularly if you look at markets like Australia, where we're 300 kilos per annum compared to China currently at about 33, Japan at 85. So a huge amount of excitement there. But also, if you look at it from a free trade agreement context, and you only have to look at New Zealand, which who finalised their free trade agreement with China in 2008, and it's I'm very conscious of not just putting this down to the free trade agreement, but it's interesting to look at market share for the Chinese dairy market pre and post New Zealand doing their free trade agreement with China. Pre-FTA, New Zealand had about a 20% market share on a total import market of about 500,000 tonnes. Flip forward to 2013, 6 years after the implementation of the FTA, and they then owned a 41% market share on a total market now worth over 2 million tonnes. So it's an 8-fold increase in dairy exports that have gone from New Zealand into the Chinese market. Obviously, there's been other factors at play. They have had enormous growth, particularly from the South Island of New Zealand, of dairy production. Obviously, you've had the melamine incident, which has really seen the increase in demand for imports more generally. But New Zealand has very much been able to capitalise on that opportunity, helped along the way by that FTA. And so obviously the excitement around our FTA, and also some of the urge of trying to capitalise on some of the market growth. Obviously looking at figures like these, and it's easy to understand why there's been such a fervour about China and that free trade agreement. So what's it actually worth with that FTA? And the reality is that at the moment we pay about $35 million a year to the Chinese government in tariff revenue. Over 11 years, those tariffs will be reduced to zero. And you assume that we're going to have higher rates of growth of our exports. We're already travelling over the last 5 years. We've travelled about 11% growth in our exports into the Chinese market. But assuming if we ramp that up to about 15% over the next 11 years or so, we're looking at about $145 million worth of tariff savings year on, year out as a result of that FTA. That's in raw dollar terms, but still it gives you a bit of a context on the value that can be generated through the supply chain as a result of these free trade agreements. And the reality is that money that would be going to the Chinese government is taken out of the equation. But we keep on arguing that value is more than just the tariff savings. The reality is that the tariffs are paid by the importers, not the exporters. But we do expect that some of those tariff savings will pass through the supply chain. But it's not just about those tariff savings. It's about our competitive positioning in the world's fastest growing dairy market. Deepening those already existing relationships that we do have in that market. So I mentioned before about even without the FTAs in place, these markets, Japan, China, Korea, are already enormous markets for our dairy producers as well. But it does help to build on those existing relationships and signalling Australia as a partner of choice. And we can't ignore some of the broader impacts that have emerged from this. Bearing in mind we haven't even signed the China Free Trade Agreement, but the amount of investment interest has escalated, particularly since the finalisation of the deal, of Chinese investors looking at partnering with Australian companies to supply the Chinese market. And they're all indicating that the certainty that will come through reducing tariffs and a preferential trading environment for Australia going into the Chinese market is a huge boon in attraction for them investing in the Australian dairy industry. And that, for an industry that is is capital deprived, looking for investment opportunities and to build and grow and tap into these opportunities is a huge boon for us. Moving to Japan, and why the disappointment? And we talked about the key emissions that were in that deal. We pay about $120 million a year to the Japanese government in tariffs each year. We think we're probably saving as a result of that about $5 million as a result of the FTA. So hardly can be called a liberalising agreement. But still a big market for us. We are losing ground to some of our competitors, particularly the United States. They have this Cooperatives Working Together program, an export subsidy program, where they're really targeting markets like Japan and tapping into it. We can see this chart over here on the right, and it really does show you a bit of the cheese export prices that are paid into the Japanese market. You can see back around 2000, there was a premium for exporting into the Japanese market. They're a finicky market, they have very demanding specifications, supply chains, a lot of complexity of supplying the Japanese market, but they commanded a premium. They're still quite demanding in terms of their expectations of the market, but as you can see, the world price is very much caught up with the prices that the Japanese are now paying. So in terms of the FTA, we're really looking to that to make sure that the value goes back into the Japanese market so we can continue to service the market and to generate the premiums that we have traditionally enjoyed there. With Korea, it was all about the relativities. This chart really just shows about the country-specific quotas that have come out of the respective FTAs with Korea. And it does show that while we do have some duty-free market access for cheese, in terms of the lukewarm response from the dairy industry on Korea, it was more about the fact that we're travelling well behind our major competitors being the United States, the European Union, and since we've completed our deal, now New Zealand obviously has also got a bigger quotas and market access as a result of their deals. We travel, by the time we get total duty-free market access, we're travelling about 7 years behind the United States and European Union in getting our access. So it's all about the relativities, as I say there, and that needs to be taken into account. And it's very important when we're looking at these free trade agreements about where do your competitors fit, where do you sit in the broader context. So, can Australian dairy capitalise on these FTAs in North Asia? And I would say absolutely. There are huge opportunities to capitalise, but there are still hurdles that remain. The first of these is technical barriers to trade, and Si mentioned this as well. And it's really pleasing to see the additional focus that we're seeing in recent times around these technical barriers to trade. They've always been there. These are the things like the onerous testing requirements at the border. These are things like certification schemes. These are things like product age restrictions and shelf life restrictions that are above and beyond what we would deem to be reasonable, take into account Australia's food safety systems and rigorous regulatory practices in place. We've recently done a study similar to the red meat industry, quantifying out the total costs of these technical barriers to trade, and we estimate it's about $1.57 billion a year to the Australian dairy industry alone. China alone, $193 million of additional cost. Not necessarily stopping trade, but definitely adding to the cost of doing trade. And we're seeing that particularly around even things like infant formula into the Chinese market at the moment. Obviously, a lot of regulations come into play in terms of which add cost to doing business in that space. Don't necessarily stop the trade, but definitely hamper it. So as I said, we're really, as an industry, trying to elevate the profile of these. So while the tariffs are coming off, we still need to be rigorous in making sure that these technical hurdles are overcome to make sure that we continue to put the pressure on. So when one barrier goes down, then another one arises. We saw an interesting example a few years back about fresh cheese going into the Japanese market, which they were concerned might be being used as a dairy spread. There was a sharp knife test that was proposed to be introduced, where if you put the sharp knife through a block of fresh cheese, and if it came out with some cheese showing that it must be a dairy spread and commands a higher tariff rate. So things like that, we've got to be onerous in making sure that we keep a track of where these kinds of hurdles can come into play. which are far from being based on science. We also need to look at the competitors in the region. If we look at Korea alone, obviously, we've talked about EU, USA and New Zealand already have their FTAs there now at preferential rates to what Australia has. So needs to be taken into account. In China, we've talked about New Zealand, obviously he still has a preferential agreement. And now in Japan, we're the first to move, but there's now this TPP that is looks like potentially being finalised in the near future, which will also give the United States and New Zealand some, bring them up to the bar in terms of market access in that market. And the European Union is also talking about doing their free trade agreement by the end of the year. So, sure, FTA by itself creates opportunities, but in many ways it's just a matter of keeping up with the Joneses. Everyone's out there doing these FTAs. They're all looking for that market opportunity, and eventually, we hope that there's going to be a situation where it's evening the bar and removing tariffs out of the system, but it's the relativities in play. It does highlight, though, that if we had not done those FTAs, that we would be moving further and further behind. So whatever the situation with those agreements, you can see there that our major competitors are very much in that space, and without those agreements, we'd be moving further behind, and that would be well to the detriment of the Australian dairy industry. Trade distorting domestic policies. I've mentioned about, and when we talk about that, we talk about the United States and European Union. The US Farm Bill, they've got a new margin insurance scheme for US dairy farmers. Obviously, provides them some insulation into global market movements. They've also got this industry-funded, not under the Farm Bill, but an industry-funded Cooperatives Working Together program, which, as I said, an export subsidy program to give them an advantage in the international market. The European Union, obviously they've had their quotas coming off in just at the 1st of April this year, which traditionally did hold them back somewhat in terms of their production capacity. But they still have a raft of interventionist measures at play, which do provide a competitive advantage. So another thing which needs to be taken into account in terms of what's our competitive positioning in these markets. Maintaining the relevance of Australian dairy in these markets is obviously also a challenge, and the harsh realities are that since 2000 our production has gone down from just about 12 billion litres, got down to around the 9 billion mark, and as I said, now up around 9.5, but still there is that struggle to maintain relevance in the global market, bearing in mind that our domestic market is still 55 to 60% of our domestic production. Obviously we had the high dollar, we had droughts and floods, depending on what region you're in. There were some challenges at play. There was obviously the adjustment after deregulation of 2000, but we still need to make sure that we have the production. There is the incentive there coming through for the Australian dairy farmer to make sure that we have the production to be able to capitalise on these opportunities. Substitution pressure is another one for us, particularly when we talk about palm oil and soy protein, the major substitutes. And we are seeing the emergence of these types of products, duo mixes mentioned here, which we're seeing across Asia now, which is a combination of dairy milk and also soy milk. So, depending on where the price points really lie, these markets are looking at alternatives to make sure they can insulate themselves from those price pressures. So another factor which again the Australian dairy industry needs to take into account in terms of capitalising on the opportunity. And importantly, and finally, about the competitor activity in Asia, targeting the Asian region. We talk about New Zealand, Fonterra, the might of Fonterra, almost 10% of the GDP of New Zealand, about 30% of their export income. A very cohesive, coordinated program of targeting the markets that are important to the Australian industry and throughout Asia. And they're doing a very fine job. They're also investing behind the border and obviously a very, very important player in the global marketplace. You talk about the European Union, as I mentioned before, quotas coming off. And again, looking for their sphere of influence, this GI creep, geographic indicators, they're common cheese names which they're looking to regulate the use of. They're really looking at their FTAs within the region as well and putting binding practices or binding regulations on the way that we can utilise those common cheese names. And also you talk about the United States now exporting over 15% of their production, traditionally seen to be more of an opportunistic exporter, with the domestic market being more of their primary focus. Whereas it's fair to say now that, that they've become more focused on the international market and they're seeing those opportunities, and individual companies within the United States are really seeing the international market as a key part of their growth strategies. So where they might have been a bit player in the past, they can no longer be seen in that way. So we're seeing them all targeting in on those same markets. Comes to the issue of branding. From a dairy perspective, we don't see this as a logo discussion. We see this as a cohesive storytelling discussion. Graham talked about earlier on today, and how we actually coordinate ourselves and providing that cohesive, collaborative story about what defines Australian food and beverage in the region. So there are real opportunities, but there are obviously real challenges there as well. So the North Asia FTAs are a bit of a mixed bag for the Australian dairy industry, but we do think that opportunities remain across all three of those, and particularly with those FTAs, if the worst possible thing is if we did not have them in place, and we'd be moving further and further behind some of those major competitors. But they won't be enough for the Australian dairy industry to capitalise, as I've outlined, but they do provide an extremely positive platform for us to work from. Thanks very much.